Let's start with the word investment. And I feel as though the minute people hear the word investment, your mind goes to a particular space where only for the wealthy, it's for the big businessman, it's for the person with the fancy degree. Investing is very simply taking your hard-earned money, putting it in an asset, putting it somewhere for to get it working for you. Very different than saving. So sometimes the word savings and investing are used interchangeably. And the thing is, yes, it's putting money aside for a future date to get a return, but there's a vast difference. You're saving for something that you know is very specific, so the returns are a lot lower versus investing where your earning potential is a lot higher. Never ever confuse saving and investing. Two very, very important vehicles. Short term will be anything 1 to 3 years. That's short. Ultra short is 1 year. Once you start to move beyond that 3-year space and it's money that you are putting aside, then you really have to start thinking about, well, okay, I need to put this money to work in a long-term asset that's going to work for me. I'll ask the question, who do you pay first? Now, paying yourself first, I just want to just clear this up because somebody might say, well, that sounds so selfish, but paying yourself is really having a line item, allotting a certain amount of money that listen, this is for my future self. Because I know the idea, you can think, well, when I start earning more money, then I would save. Or when this happens, then this would happen. But I'm telling you, I know it always goes that way because you always keep pushing it further, pushing it out. And it's the importance of having the discipline when you have little or what you think might be little. Once you start managing that correctly, then you are positioned for when you start to make more money. So the two traditional types of investment vehicles are stocks and bonds. So the two ways that a company can raise money is either by saying, listen, you know what, I'm going to give you some ownership in this company. You're going to give me some money. And as a result, now you have some rights to share any profits, right? The other way they can do that is saying, listen, can you give me a loan so that I can expand the business and buy the stuff that I need to buy, and I'll pay you back at a certain time. A bond is really a contractual agreement to pay back because there's a cost to borrow. Same way that you're going to go to the bank to get a loan, it's the same way corporations and governments have to borrow money to do different things. A newcomer investor, a good place to start off is in a mutual fund. Think about a basket of investments, a basket of stocks and bonds, or sometimes a basket of just stocks or a basket of just bonds. Pool together, all of us pooling our money together, and someone is managing that on our behalf. We pay them a fee and we get the returns from stocks, the stocks and the bonds. A stock will earn money now because if the company is doing well and the profits are increasing, people are going to want to buy this stock and the company can pay a dividend. Capital appreciation, that's the price going up. So you bought at $1 and now it's $1.50. The stock price has appreciated. The company decides they're going to pay you some of the profits in a dividend, you get some money there. So you earn that way through stocks. With a bond, how you earn is just straight the contractual agreement to pay that interest because there's a cost to borrow. With stocks, you're not guaranteed to get a dividend. You're not guaranteed that a stock price will appreciate. If you don't have an emergency fund, as in you can't withstand, like if something happens, you don't have cash put aside in a savings type of account that's secure, that you have access to, then you need to you probably just want to hold strain a little bit before you actually do decide to go and invest in the stock market.